Yeah, Abhishek, we can start the meeting.
Yeah, so thank you very much for joining. So today we will be discussing about personal finance and investing. So this type of session gives you an independent opinion to get started and to motivate you what is good for you. So if any questions you have, you can put the questions at the end of the session. But if there is anything regarding the presentation, please feel free to ask. So let's start this journey. So this will be the flow of the presentation. And as I told you, if you have any doubts regarding any point on presentation, you can ask me in between. Otherwise, you can ask at the end any personal finance related query. So, but the most important thing is that here we are today to discuss about money. We all work to earn money, right? It is equally important to make sure that money works for you. But you might be asking that we all are doing savings. So what's the problem? The problem is that in our country, inflation is growing at 6% and bank FD and savings account is giving only 5 to 3%. So if you're keeping your money in bank FD or savings, unfortunately, the growth of your money is negative. So that's the reason it's very important to make sure that money works for you. What is the way out? The way out is to give direction to your money in form of goals of life. When you are giving direction to your money works in your best interest and you can easily achieve your goals of life. We will discuss more about goals of life and how you can reach your goals. But before that, as you can see in the screen, mutual fund. So what is mutual fund? Mutual fund is an investment vehicle which helps you to reach your goals of life, whether short term or long term, in a stable manner. In a stable manner so that you are able to beat inflation by a good margin and you are making better post-tax return. Because see, we all are working professional, we pay taxes to government of India. So it is equally important to make sure that the investments or savings which we are doing are tax efficient. Tax efficient means we are liable to pay very less tax. So mutual fund is a vehicle which will help us to reach the goals of life. How it will help us, we will discuss in slides going forward. So in this slides, you can see if you're a person having a 1 year, 3 year, 5 year, or 10 years goal, there is every option of mutual fund available to you. If your goals are long term, you can invest. Long term means anything above 5 years. If your goals are long term, you can invest in equity mutual fund and reach your goals. But before that, goals are there, right? We all have goals like children education, buying a house, buying a car. But how to reach those goals? The answer is investing. For example, for example, we understand that we have goals of life, but how to grow the assets? We need to put our money in different assets. In our country, broadly, we have four assets. One is fixed income, which we all do in form of bank FDs, but there are other fixed income option also. Rather than giving money to bank, you can lend to corporates like Bajaj Finance, Shriram Transport, or you can lend to government like Reserve Bank of India, RBI. Thereby, you get a fixed income, which is called fixed income. Now, the next asset is gold. Gold and fixed income are a protection asset. It will not grow your money, but it will protect your money. Gold, we all have inclination to buy gold, right? But the best way to buy gold is through Reserve Bank of India. Why? See, jewelry, if you're buying gold in form of jewelry, it is for the purpose of consumption, not for the purpose of investment. But if you are planning to have exposure in gold as an investment, you should ideally go via Reserve Bank of India. The reason is that when you buy gold through RBI, RBI gives 2.5% interest every year. They don't charge GST. Apart from that, whatever gains you make, the gains are tax free for you. Let's say you have purchased 10-gram gold for 50,000 and after 8 years the value is 1 lakh rupees. You don't pay any tax to government of India. So gold and fixed income are protection asset. They are mainly used by people for short to medium term goals of life so that they can get better than FDRD rates and reach their goals in time. For example, people with a 3 years outlook, they can invest in fixed income option and reach the short term goals of life. But what about the long term goals? For long-term goals, there are two assets. One is equity and another is real estate. So first, let us discuss about equity. Equity means you are taking ownership in a company. For example, if you are following news today, one of the startups, which I guess we all use nowadays, Zomato. Zomato got listed. Got listed means first time it entered the market. Now, normal individual like you and me can buy shares of Zomato. And those who have applied for Zomato IPO means applying to the first time issue of shares. People had made 70 to 75% return in 1 day's time. So why I'm telling you Zomato, why I'm giving you this example, this is equity. You take ownership in a company. If company does well in the future, your money grows. If not, vice versa. But equity is the best growth asset in the world. The reason is that if you go by the last 20, 30 years data of Indian markets, Indian market has grown at 16%. So if your money is growing at 16%, then every 4.5 years, you're doubling your investment. So equity is one of the best growth assets, but the answer to equity is that you need to give time. Time means 5 years time, 7 years time. Why? Because in FD, what happens? Every year, you will be getting 5% for sure. But in equity, that is not the case. 1 year, it will be 30%. 1 year, it will be minus 10%. So fluctuations are there. That's why you hear mutual funds are subject to market risk. Risk is there, but risk can become a good friend if you can give time to your investment. How much time? At least 5 years time. Lower to lower side, 3 years time. So equity is the best asset class where you can invest and be part of the ownership, take ownership of the company by starting a very small investment. That is equity, and equity is considered the best asset class in the world. Apart from equity, real estate. Real estate is also very close to the heart of Indians. But real estate for the purpose of living right now is a very good time because home loans are available at 6.6% and there is a lot of inventory lying unsold. But for the purpose of investment, when it comes to residential in real estate, the return on investment is very less. So these are the broadly 4 assets which will help us to reach all our goals of life. It's not this versus that, it's about proper planning and having exposure in all of them, which is called asset allocation. Asset allocation is like a balanced thali, which is good for your financial health. Now this chart looks very complicated, but let me take those points which are vital for any individual. So structure of a mutual fund is created in such a way so that investors' interest is protected at all point of time. For example, when it comes to State Bank of India, which is a top bank of our country, there has a subsidiary which is State Bank of Mutual Fund. So Government of India, when it comes to giving license of mutual fund, it is very prudent on giving license to people who are prominent and who have the capital and who can run the business in a very proper manner. Because when you are giving money to mutual fund are managing public money, so it has to be given to those persons who are capable enough to grow the business. So all these structures are created of trustee, mutual fund, asset management, so that our interest as an investor is protected at all point of time. So we have discussed about the return of investing, but what is the risk? Right. So when I told you equity as an asset class has given 16% return, you should ask me what is the risk? The risk is 30. If you invest 100 rupees today in equity, be prepared that 100 can become 87. So 13 is the number of risk, but as I told you, risk can become your friend if you are giving time to your investment. And in this chart, you can see liquid funds are those funds which gives better than savings. So they are least risk investment. And mid cap fund or a small cap fund are those investment which you need to give 5 to 7 years time, and they are high risk investment. So this is the risk category of an investment. Apart from that, there is something called ELSs. ELSs means ATC investment, which gives you tax benefit. If you do an investment in bank FD for ATC, the lock-in is 5 years. If you do a PPF investment, the lock-in is 15 years. But if you do a insurance, again the lock-in is 5 years. But if you do a mutual fund investment for tax saving purpose, the lock-in is only 3 years. So this type of instruments, this type of rules are created so that government is nudging you to do good, to do what is good for an individual. So this is how the structure is created by the government to make us self-aware, to make us a balanced individual who is taking part in India's growth story. So when a mutual fund is created, mutual fund has an asset management company. As you can understand by the name, asset management means they invest in different assets and help you to grow your wealth. So this is a very simple chart which will give you the understanding. As an investor, we give money to mutual fund manager. Mutual fund manager will invest in different assets and give you returns. For this, how much they charge? They charge hardly 1 to 2%. But apart from that, let me give some numbers. If you have invested in Nifty 50, which represents the growth of the country, it has grown at 16%, as I told you. But if you invest in an equity mutual fund, the job is to beat the Nifty 50 return. What the mutual fund has given? They have given 18-19%. Post this 1 to 2% fees which they are charging for managing your money. So this is how investments can work. This is how investments can grow and help you to get good return over a period of time. So now based on classification, classification is nothing but to make mutual fund investment very simple. These are the broad classification. So let me go one by one. As I told you, tax saving funds has a lock-in of 3 years, tax saving mutual fund. They are known as close-ended fund. Before 3 years, you cannot exit them. Same way, if you're planning to invest in your children's education or if you're planning to invest in your retirement, then again they come with a lock-in of 5 years. Those are close-ended. You cannot move out before 5 years. Apart from that, open-ended funds are those funds, mutual funds, most of the mutual fund investments are nowadays open-ended. What does that mean? You can enter anytime, you can move out anytime. There is no restriction that your money is locked in for 3 years, 5 years when it comes to open-ended schemes. So open-ended funds, you can withdraw anytime, you can go away anytime, but there is a small penalty. If you are a person who is investing for 5 years in equity fund and if you move out before 1 year, mutual fund houses will levy 1% penalty to discourage you to do what is wrong for you. Because equity as an asset class gives very good return if you're staying for the long term. So this small type of penalties are there to nudge you to do what is good for you. Apart from that, based on investment objective, equity funds, as you can understand, they invest in equities. Apart from that, fixed income funds, as I told you, you can lend money to bank, you can lend money to different government, you can lend money to corporates. This you can do via mutual fund also. Because see, as an individual, identifying which government will do well, which company will do well is a very big thing. So it's better to give the money to professionals whose bread and butter is to manage your money. Right. Apart from that, the last category is hybrid. For people who are not comfortable with the fluctuation of equity, but still they want some sort of return. For them, there is something called hybrid category, which is a mixture category where you get return, you get better return, but stability also. So these are the broad investment objective, and the last is active passive. As I told you, if you are a person who wants to be grow with the country and you are very happy with 16% growth, that is called passive investment. You do nothing, you don't bet on any mutual fund, you just simply bet on the country's growth story and your money grows over a period of time. That is passive fund. Now active funds are those funds where mutual fund manager will take money from you. His job is to beat the benchmark, which is Nifty 50 in case of equity funds. So these are the broad types which we have discussed. Now the last part is categorization is solution oriented, I have told you, but other categories is for people who want to invest in global companies like Amazon, Microsoft, Facebook, Google, the wealth creators of the world which we use day in, day out in our lives. There is international funds also available. But what is the reason of going international? Because India is an emerging country, you might be asking. Yes, India is an emerging country, but different geographies perform well at different points of time. If you go by the number, Amazon in last 10 years has grown more than 30% year on year. Microsoft 26% year on year. So that is how these companies are creating massive wealth and massive value creation in the society. So international investment can be done very simply using a mutual fund route. Now we have understood that yes, mutual funds are good for an individual, but how to get started? The process is very simple. You can do it online, you can do it offline, whatever is comfortable for you. Nowadays, there are multiple mobile apps also where you can get started, right? And what are the documents needed? Documents is you need a bank account, you need passport size photos, and you need KYC documents. Once KYC is done, KYC is centralized KYC. You have to do it once, it will be there forever. So to get started, it takes hardly 1 week time if you are a first time investor. And once the process is done, you can get started very easily. You can withdraw your money online, offline, whatever you are comfortable with. Now coming to the investment modes in mutual fund. So in mutual funds, there are two types of investment. One is SIP, which is nothing but monthly investment. Like we do EMI to buy a house, same way we encourage people to do SIP so that you are creating wealth for your long term. Apart from that, for people who have one time money like 10,000, 1 lakh rupees, they can do one time investments also. To give you some motivation, let me give my example. I did my first investment in 2013 May, lakh rupees. Right now, the value of lakh is 4.7 lakh rupees. What is the growth rate? The growth rate is 20%. That's how mutual fund can create wealth over a period of time. Now, SIP, we all are salaried individuals, so SIP is something which we should do. But what is the benefit of SIP? Many people are of the misconception that to start investment, you need a big sum. Yeah, someone is saying anything?
Nothing, you can go.
Okay. So, SIP is a very good way to start investments for salaried individual. But many people have the misconception that you need a big sum to get started. That is not the case. To get started, you need hardly 500 to 1000 rupees. And this 1000 rupees can make a hell lot of difference in our investment journey. How it makes a difference? Just see the slide. If a person at the age of 25 is investing 1000 rupees in equity, till the time he retires at the 60, he can easily create a corpus of more than 1 crore rupees. But you need to see, as a person who is regularly doing 1000 rupees, once he reaches 50, 55, 30, 60, the growth of his wealth is massive. That is the power of compounding. If you're able to compound your wealth consistently in equity, you can create a massive amount of wealth. So 1000 rupees makes a difference in life, but doing it on regular basis is most important thing. Now 1000 rupees is something which most of us will be able to do, but what about 5000? If you do a 5000 rupees over a period till the time you retire, you can have around 6 crore corpus lying in your bank account. That's the power of equity, right, friends? So that's how the growth story of equity is about. And equity means you are taking part in the growth of the country. If country is growing, you are making money. Country is growing, your money is growing. So it's a very good thing for the society. Now coming to the part, what is the outflow and inflow? You can see the difference. The more time you give to your small investment, it becomes humongous over a period of time. That is the power of compounding, which you know is the eighth wonder of the world. Now we all work every year, we wait for salary hikes. Same way, we encourage people to do a 5% hike of your SIP investment. If you do that in equity, you can create a very good amount of wealth over a period of time. So now, if a person is delaying the investment, you can see a person starting 1000 rupees at the age of 25 versus person starting 1000 rupees at the age of 28. By delaying the matter by 3 years, he is missing 35% of the wealth creation journey. So that is why when you are doing investing, it's always better to start early. In our investment world, our guru is Warren Buffett. who started investing at the age of 12. Right now he is 90. And for last 40 years, he is the top richest person of the world. So that's the power of investing, giving time to your investment, making your money work for you. Now coming to the investment modes in mutual fund, there are two type of investment option. One is a direct and one is regular. What is direct? Direct means you do it yourself. You don't involve a middleman. Regular means you take hand holding of a person who charges a small 1% fee from you. The fees you don't pay, but it's the scheme which pays for you. So you might be thinking that mutual funds are so good investment product. Why in India it is not that much popular? The answer is that when it comes to insurance, which most of us would be having, insurance, when a person sells an insurance, the incentive is 20%. If a person is selling mutual fund, the incentive is 1%. So you can understand the push is not there. So that's the reason mutual fund investments has not taken off in a great manner, but of late means last 1 to 2 years, people have understand investments. They have started investing in the Indian markets, which is a good thing for the country. Now the next part is that growth versus dividend. People who are looking for long-term growth story, they should go for growth option. And people who are looking for yearly, monthly, half-yearly incomes, they can go for dividend option. Dividend means whatever profit they get, they distribute to you as income. Now, for people who are about to retire or who are looking for monthly income, they can use the systematic withdrawal plan where they give money to a mutual fund manager. Mutual fund manager will invest in short-term assets and give you better post-tax return than traditional bank FDRD. So as you can see, whether you are a person who is starting off or whether you are a person who is about to retire, mutual fund is a vehicle which can be used by everyone. There are different options available, there are different schemes available, but you need to choose what is good for you. You need to choose what is good for your goals of life according to your risk profile. So mutual fund is a very good investment vehicle. That's the reason we say mutual fund sahi hai, but you need to choose the mutual fund which is good for you. That is also important. Now the last part of the presentation is insurance. So as I was telling you, insurance we all have because our friends, relatives nudge us and we buy insurance. But insurance is for protection, not for investment. Why is this coming from the background? If you can mute yourself, it would be great. Thank you very much. So insurance is not for investment, it's for protection, protecting from emergencies of life. So ideally, person should have a term insurance and health insurance. No other insurance is required. Why? Why? Because when you do a term insurance, for example, if a person is 25, he buys a term insurance of 1 crore, he pays hardly 750 rupees per month. As the age grows up, the premium of term insurance also grows up. So insurance and investment, the earlier you buy, the better it is. But in case of term insurance, the thing is that if you have people dependent on you, you should have a term insurance. For example, in my case, if any time before 75 I am not in this world, the nominee will get a corpus of 2 crore. So that is term insurance. If you are not in this world, family will not have financial stress, though they will be having emotional stress. Now, people might be thinking that we have LIC where we are giving some money and at the maturity we get some capital. With that we get some coverage. What is wrong in that? The problem is that in term insurance, if I'm living in this world till 75, I don't get any rupee, right? But in endowment plan, what happens? I pay monthly for the next 15 years. If anything happens to me, nominee gets 6 lakhs, and if nothing happens to me, I get a maturity benefit. We all do this type of policies, right, which is known as endowment plan. Rather than doing that, if you buy a term cover of 400 rupees per month for 25 lakh rupees, And the balance amount, if you invest in fixed income mutual fund, not equity, my friends, fixed income, you get a higher life coverage and you get a higher return. So that's the objective. Combining insurance and investment is not a good thing. Is insurance bad? No, insurance is a very good thing for protection. And one good part of endowment plan is that the returns are tax-free returns. So every product has its own benefit, own limitations. You as an investor need to decide which one is best for you. Now the next part is, in insurance, they did some innovation. What they do is that they give you a life cover for the next 15 years and they give you higher return because they invest in equity. That is called ULIP. They invest in equity mutual fund. Rather than doing that, if you go for a pure term cover and invest the money in equity mutual fund, you make more money. You get a higher cover of 25 lakhs versus you make more return on investment. That's how it works, right? Now the last part is medical expenses, which is growing day by day. It's better to have personal health cover apart from company cover, because company cover we get 3 to 5 lakhs. But in 3 to 5 lakhs, is it enough if you get some big diseases for God's sake? And the treatment cost can be very high. So it's always better to have a personal health cover. And if you're a person whose age is below 45, you can get a 25 lakhs cover by paying a premium of 26 to 27,000 for the entire family of 4. And in this premium, you get tax benefit also. Apart from ATC, Government of India gives additional tax benefit in health insurance. And in most of the health insurance companies nowadays, you get cashless benefits. Right, so that if there is some health emergencies in life, your savings, your investment is not get impacted, and you have peace of mind when it comes to financial aspect. So that's the reason having a health insurance is always advisable, not from the tax saving point of view, but in general, it is very good to have a health insurance of personal health. Now, the last thing is that in mutual fund, we have offer document, which gives you all the data. Who is the fund manager? What has been the past track record? Where he has been investing? What is the return? What are the holdings? Everything you get to know. Mutual fund is one of the transparent financial product in the world. Right? What is the asset allocation? What is the fees he is charging? All things are available. Just you need to do some reading, basic reading. That's it. Now the last part is that every investment will have a riskometer. Riskometer will tell you what is the level of risk the fund is taking. So as you can understand, equity which gives higher return, they will always have high or very high risk. But funds like liquid funds which give better than savings return, they will have low risk. Or funds like short-term debt funds, short-term fixed income fund which gives better than FD ratings, they will have low to moderate risk. So as I told you, risk is something which we should not fear, but we should understand and make use of it. Because risk is a way which can gives you higher return, but you should know how to manage the risk. And as I told you, the best way to manage the risk is to give time to your investment. So that's it from my side. If you have any questions, please feel free to ask. I will be more than happy to address your queries. Anything related to personal finance, investment, global investment, fixed income investment, government bonds, anything related to investments. This type of forum gives you an independent opinion on what is good for you as an individual. Because on my part, I am not associated with any mutual fund house. I am a SEBI impaneled trainer, and my job is to give you the right guidance. Hope the session was useful for you. Thank you very much for joining. If you have any questions, you can drop in chat, or you can unmute yourself, whatever is comfortable for you.
Can we explain SGB?
Yeah, SGB is sovereign gold bonds, which are issued by Reserve Bank of India. In a year, 5 to 6 times they come with the issue. where you buy gold directly from RBI, and to buy SGB you need a demat. And as I told you in the presentation, if you're buying SGB for 8 years, you don't have to pay any tax to government on capital gain. Apart from that, Government of India every year they give you 2.5% interest as an incentive. And the one more point which I have missed is that when you buy a SGB, Government of India gives a 50 rupees discount on the gold prices. So it's a very good way to have exposure in gold as an investment. Hope that answers your query.
Yes.
Okay, Mr. Pawan. Yeah, anyone, anything else?
Team, anyone have any questions? Yes, Ashish.
Apart from that, yeah, someone is saying something.
Team, anyone have any queries?
Hi, this is Sunita. I
Ashmita?
just want to ask if NPS is a good investment and how much it is going to help with the tax benefits.
See, NPS is a good investment from retirement point of view, and Government of India gives 50,000 additional tax benefit for national pension scheme apart from ATC. You would be aware that ATC the limit is 1.5, but if you do an NPS investment, government gives 50,000 tax benefit. But the problem with NPS is that it has a stringent lock-in provision. But the best part is that if you go by last 10 to 12 years data, NPS has very easily delivered more than 10% return, which is a very good number. Because if you go by PPF, the current PPF rate is 7.15%, right? So NPS is a good option from tax saving point of view, and it is a good option for planning your retirement also. And now when it comes to NPS, for better clarity of everyone, when you retire at the age of 50, 55, whatever it may be, two-thirds of the capital will be given to you as one time, and the balance amount you have to buy a annuity. What is annuity? Annuity give you lifelong income till the time you are in this world. Once a person dies out, the nominee will get the corpus directly. So in NPS, this is the criteria. But the only problem is that annuity returns are only 5%, and that too it is taxable. So government is working to make it more efficient. Let's hope for the best.
Thank you.
Thank you very much.
Yes, I have a question here. So I wanted to know more about this SIP. Whenever I start planning to do this SIP, I have number of questions in my mind. So with the small investment, can I do this SIP? Just can you please explain on that?
Yeah. You can start with as low as 500 rupees. And the best part with SIP is that if any time you want to stop SIP or any time you want to increase or reduce the value, you have full freedom.
Okay, whenever I want to withdraw, I can withdraw this amount, right?
As I told you, if you are investing in a long-term fund like equity, if you
Okay.
withdraw before 1 year, there is penalty of 1% to discourage you to do what is not good for you. That's the
Okay.
reason. But if you invest in short-term fund, there is no penalty.
So there's a difference of investing in short term and long term here.
Yeah. As
Thank
you as I have told you, in short term you get better than FDRD rates. There is
you.
no penalty. But if you do a long-term investing like equity funds, you get higher return. But that higher return comes if you give time. So if you withdraw your money before 1 year, you might lose capital also. To discourage you from such steps, they have a penalty of just 1%.
Thank you. Thank you. Got it.
Yeah, thank you, Lavan. Yeah, guys, anyone, anything else?
I think Pavan, everybody is done. I think so. Nobody has any question. Pavan, you there?
Yes, Laran. So, so you says it in before you said that about mutual fund. So we can invest in mutual fund. We can save it for that short term for 3 years, right? So compare with the PPA of these things and all.
Yeah.
So, which plan is the good for the for mutual fund for the short term?
See, first of all, in mutual funds, there are multiple schemes, and you are asking about short term. So, short term, I'm assuming that short term means you are planning to invest for 1 to 2 years.
Yeah, 3 years.
Let's say 3 years. So, in 3 years, you can go for conservative hybrid funds,
Okay.
which will have some part in equity and maximum part in fixed income. And if you go for 3 years, they can easily deliver you around 9 to 10% return. It is called conservative hybrid.
Conservative. Okay.
Conservative hybrid from a 3 years outlook. So I guess a question has come up in chat. I just missed it. I'm not able to see that. Can someone help me with that?
Uh, when we fill in STCG filling, can we get deduction in SST and SEBA turn on fee for buying and selling?
See, if you can ask the question, Mr. Mirza, I will be happy to answer.
Yeah, actually, I was asking that when we fill in the short-term capital gain taxation, so suppose if we buy any instrument for suppose for 2000 rupees and there's some tax on it,
Yeah.
suppose 5 or 10 rupees, and similarly, and
Mhm.
when we sell that instrument before 1 year, any shares,
Mhm.
so
Mhm.
we again we tax like 5 to 10 rupees, say we turnover tax and
Mhm.
STT tax. So like on a
Correct.
sum total, we are deducted 10 on both sides, buy and sell. That is 20 rupees. And
Mhm.
suppose if we are gaining suppose 50 rupees or 100 rupees, so this 20 rupees will be subtracted from that 100 rupees gain while
Yeah,
filing, or
obviously. Yeah, see, so first of all, STTT is always securities transaction tax. You are always liable to pay when you do some transaction.
Mhm.
So whatever gains are there, it will automatically get deducted. That is there. Number two is that for the betterment of audience, when you are investing in equity, if you are making any gain, for example, today Zomato got listed, those people who have booked profit of 75%, since they have sold their investment before 1 year, they are liable to pay only 15% tax. For example, I may be a tax paying citizen at the rate of 30%, but when it comes to equity, I'm only liable to pay 15% tax on gain short term. If I'm doing a long term investment, let's say people who will be selling Zomato after 1 year, I am liable to pay only 10% tax, that too over gain of 1 lakh rupees. So equity is an investment which is tax efficient also compared to traditional bank MD and RDs, where you are liable to pay tax as per your tax slab. Yeah, anyone, anything else?
Abhishek, can you repeat once about the term insurance once again, please?
Yeah, no issue. So term insurance is something which every individual should have if you have people dependent on you. For example, when you take a term insurance, you need to calculate what is the human life value. Human life value means for the next 20-25 years, you will be working. What should be the life value if you are not in this world? For example, to make matters very simple, in India, when IPL happened first time, I guess most of us would be aware of cricket. So when IPL happened first time, Mahendra Singh Dhoni had a term cover of 100 crores. Why? because it was estimated that for next 10 years he will be earning that money. That was his human life value. In the same way, you should have a term cover as per your human life value. If something happens to any individual, the family should not have any financial stress. They should have a good sum so that they can have financial freedom. For example, in insurance plan, generally we have a cover of 10 lakh, 20 lakh. But is that enough for the family to have same standard of living till the time they are in this world? The answer is no.
So,
That's the reason it's better to have a term cover, and the earlier you buy, the better it is. So person who is buying at 30, 35, the premium will be very less. And when you do a term cover, it comes under ATC also. You get ATC benefits.
In market, we have different kinds of mutual funds are there.
Yeah.
So, yeah, then how to choose which one is the best so that we can invest in that.
Yeah, so as you have rightly mentioned, there are different types of mutual funds. So the basic thing you should check in a mutual fund is that how they has performed, how they have been able to beat the benchmark. If it is an equity fund, on what is the level they are able to beat the Nifty 50 return? How has been the performance against the peers in the industry? What is the risk they are taking? As I told you, equity has a risk of 13. Check the level of risk the fund is taking. This type of things gives you an idea whether it is a good fund to go for or not. Apart from that, check who is the fund manager, for how long he has been there in the system. This gives you a confidence that it is a stable fund house. So these are the few parameters where you can choose a right mutual fund for you. But if choosing becomes a challenge for first time investor, you should ideally start with Nifty 50, which represents the growth of the country. Hope that answers your query, Mr. Shiva.
Yeah, but as a startup like me, I had a few things in my mind. Generally, some people invest on the directly on buying the equity shares.
Yeah, yeah.
Okay, so if you go for the mutual funds means then there is a chargeable in and out. There is a chargeable kind of things are there on the while
Yeah.
buying the mutual funds.
While
So,
buying a mutual fund, you don't pay any charges.
but
See,
depends upon the fund which you are buying. If it is open-ended or closed-ended or some, it depends. Which
see,
I see.
charges, what charges you are saying? You are
Allocation
saying
charges.
about the, yeah, allocation charges is there, which is 1 to 2%. That's absolutely correct.
Yeah.
But let's imagine, for example, what I did. I invested in a fund, Parag Parikh Flexi Cap, as I was giving you the example. So I got return of 20% and the fund manager charged me every year 2%. Still, I made 20% return. So fund manager has done the job. It has beaten Nifty 50 by 4%, which is a big number, right?
Yeah.
Just imagine in a span of 8 years, it has 10 rupees has become 47 rupees.
Yeah.
So if you're paying a small charges, allocation charges or fund management charges, which we call in our industry, but if he's able to create wealth for you, create value for you, then these charges are very nominal, Shiva.
Yeah, that's absolutely correct. But what my question is that if you give some kind of funds as an example,
Yeah.
these are the funds which is a very performing very well in the market, so that we can look into those funds. That's
Yeah.
what I'm expecting.
So you are asking some name of high quality funds or how it is?
Yeah, yeah, that's
So as I told you, I gave one of the example, Parag Parikh Flexi. It's a very good fund for people who are planning to invest for 5 years outlook. If you go by the fund, they invest in 25 companies. Out of those 25, 5 companies are Microsoft, Facebook, Google, Amazon, Nestle Switzerland, and 20 companies are Indian companies. It's a very good fund for long term. So it is one of the example which you can still replicate from a long term outlook, 5 years outlook.
okay. Okay, thank you.
Yeah, thank you, Shiva. Yeah, guys, anyone, anything else?
Hi, So I just want to talk about this medical exemption. I'm not aware of this medical. So can you talk about medical exemption if you can provide on that? Comes under which act, like APC or ATD? Like
80D. It's 80D. So when it comes to medical insurance, there are two parts. One is that you take a medical insurance for yourself and your family. Your family means your spouse, your children. There you get 25,000 deduction. And one part is that you're taking insurance for your parents. Then there is additional 25,000 deduction. And if your parents are senior citizen, then that 25,000 becomes 50,000 deduction. So when you take a health insurance for your family and your parents, Government of India gives deduction up to 75,000 rupees. So that you protect yourself from health emergencies of life. And in terms of health insurance, most of the health insurance gives you yearly health checkup where you can do a full body checkup once in a year. That's the benefit of health insurance schemes. And try to go for those health insurance, where network hospitals are located in your vicinity. So that if something wrong happens, you can use cashless benefits and get yourself treated.
so, you're talking about the health insurance which provided by the company or a third party?
I'm talking about health insurance. See, company health insurance is there, which is a very good thing. But apart from company insurance, if you buy insurance for yourself, then Government of India gives you tax benefit under Section 80D.
Okay.
Yeah, because company health insurance, it is company paying. You are not getting tax benefit on that.
So we can claim up to 25,000.
25,000 for your family and 25 to 50,000 for your parents. 50,000 if your parents' age is above 60.
Okay. Thank you.
So, for example, if you are a person in the higher tax slab, like 30%, if you are paying a premium of 25,000, the actual cost for you would be 17,000 because of the tax benefit. Apart from that, you get health checkups. If you deduct health checkups cost also, the actual cost comes down to 12 to 13,000 rupees, which is a very good deal for people. Yeah, so I guess all the questions are being answered.
Team, anyone have any queries, any questions about insurance and mutual funds and health insurance?
Hello.
Yeah.
So while taking mutual funds, should we go with the banks? I mean, ICICI Bank will provide a good mutual fund instead of going to any XYZ
See,
company.
first of all, if you're buying mutual fund, just check that the entity is registered or not. If it is SEBI registered, then it is no problem. If it is XYZ or ICICI Bank, it is no problem. But one problem which I see with banks is that they will try to push their own products. For example, if you go for ICICI Bank, they will try to give you only ICICI mutual fund products. That's the one problem I see.
Okay.
So most important thing in investment is to check that the entity through whom you are buying any investment, it is registered with SEBI or not. That is the first filter.
Okay. Okay. Thank you.
Yeah.
Uh, like to check whether it's registered with SEBI, is there we can check online?
Yeah, you can check online or you can ask the entity, please give me your SEBI registration number. They will give you the number. And if you just do a Google search with the number, you get all the data.
Okay.
Yeah.
I hope all the questions you answered.
Yeah. So thank you very much for your time. It was nice interacting with you. If you have any queries, do get in touch. We will be more than happy to address your queries. So thank you very much for being a lovely audience. See you soon.
I have one, if you don't mind.
Yeah.
Okay.
So
Please go
there are
ahead.
two ways of filing the taxes. After 2020, the government has introduced a new kind of
Yeah.
tax filing, and there is an old one. So what is the
Yeah.
basic difference between both of them, and which would benefit the tax filer?
You see, first of all, there are two regimes which government has created. That's absolutely correct. But if you are a person who uses HRA benefits, if you are a person who uses your PF contribution benefit, then the new is not better, old is better off. But if you are a person who is not doing anything, neither claiming HRA, neither doing PF, or neither doing ATC investment, for them, new tax scheme is better. So if you ask me on a personal level, old scheme is always better. But if you are a person who is not making use of any deductions available in the system, then you can consider for new tax regime.
Okay, yeah, thank you. And also, like, if 1 year, if we file in one way, and the other year, can we
You can
change the
you
way?
can change.
Oh,
Once a year you can change. For example, this year you go for new, next year you can go for old. That freedom is there.
oh, okay, yeah, yeah. Thank you.
Yeah. Thanks, Abhijit. Thanks for
Yeah,
joining
thank you.
and that clear to have a session and good session. Okay. So thanks for
Thank,
clearing all the questions for my employees' questions as well. Okay.
thank you very much, Mr. Pawan.
Yeah. Thank you. Thank you so much. Abhishek.
Thank you.
Thank you all. Thanks for joining.
Thank you. Thank you all.
Thank you.
Thank you all.